taxes. Let's go into the next thing.
Yep. So here are the four things, David Walker. We've hit all this, right? But understand that there are more forces than just the entitlements, right? We have entitlements, our national debt is going up. And when you retire, this is another big thing that a lot of people aren't aware of. The biggest deductions for most people while working are their kids and their mortgage. And if you do everything right, hopefully your kids aren't still a deduction. That's a bad thing.
Well, they can't be still a deduction.
Yeah, that means they're living with you and dependent on you. Hopefully that's not the case. And then also, we hope that your house is paid off, or at least most people are aspiring toward that. So the two largest deductions are gone, which means you could actually make less income, yet pay more taxes.
Because you have nothing to offset or deduct.
You're naked in front of the IRS, essentially. And then the last one is inflation. Go back to this for a second. Do you think, if the highest bracket, I don't remember where the split is, $250,000 or whatever the split is, one way for them to raise taxes without raising taxes is leave the cutoffs at the same point and not adjust them with inflation. Because 30 years from now, 100 grand isn't going to be what 100 grand is now, but that you're going to be rich. You're going to be in higher tax brackets because you're making that. Does that make sense? So inflation is naturally going to push us
into higher tax brackets
as well.
Right. Okay? So and that right there is kind of a crazy thing. Because when you think about that, just think 10 years ago, how much did a tank of gas cost you or a loaf of bread? Those are still the exact same things that you're going to need in retirement, but yet, it costs more, which means you're going to have to take more money out as income to accommodate that kind of stuff. And healthcare is a huge expense that is far above the cost of inflation or the rate of inflation, which will really push you into a higher tax bracket.
Yep. Okay, so if we beat that horse,
yeah, boom, it's dead.
Okay, got it.
So let's go into Social Security. Let's now talk about what the impact of deferring your taxes can potentially be, okay? So when Social Security is coming out of your paycheck today, you can see a line on it saying, okay, we're taking Social Security every single paycheck that you get, and it feels like a tax today, right? Because it's money that we don't have, it's money that we don't get to spend.
Yep.
And the thought is, at some future point when we're able to start taking Social Security, we're now going to get that Social Security back and be able to spend it. It's kind of our government-sponsored pension, right? Most people don't know this, but when we actually start talking about Social Security, did you know that your Social Security can and will be taxed unless it fits a very specific formula? So what that means is, really what it means is that your taxes, you're going to pay Social Security on twice, or you're going to pay taxes on your Social Security twice. So let's go through this provisional income, and let's go through the married filing jointly. So when you're taking your income, everything that you get from, whether it's coming from rental houses, whether it's coming from a 401k, whatever income that you're being designated as having earned in that year, you have to pay taxes on.
Yeah. So let's back up. There's a calculation when you start receiving Social Security income that needs to be done, and that's called a provisional income calculation.
Yeah. And
what Ryan was saying is basically what they do is they dump all the money that you're making, with a very few minor exceptions, into a bucket. And they say if that bucket exceeds or is less than $32,000, then none of your Social Security is taxed. Now, you would think if we're trying to analyze how much our Social Security is taxed, we wouldn't throw Social Security in there. But it is. So it's included in the calculation to see whether you're taxed on it or not, which just seems rotten.
Well, and that's the crazy thing. So 50% of your Social Security is going to go into your earned income for the year, and it's going to bump up your tax rate. So if you're above $32,000, $1 above that, how much do you think you're going to pay on Social Security? Maybe 5% in taxes, 10%?
That's kind of the way we're used to, right? 50% of now all of your Social Security is taxable. Okay, so it's not everything above the $32,000. It's everything. It's a cliff. You fall off the cliff, you're done. 50% is taxable.
So if you're making over as a married couple filing jointly, if you have over $44,000 in income for the year, and that also again includes half of your Social Security for the year.
Yep.
85% of your Social Security is going to be taxed.
So how many out there want to retire making more than $44,000 a year?
Oh man, I hope everyone's raising their hand on that one.
Right? So basically, you need to understand 85% of your Social Security is going to be taxed.
So it kind of comes back to, why are we bringing this up? Where does your income come from? Remember when we talked about, being an employee, it matters where you're getting your money. That's going to determine your tax rate.
So this is the first secret of eliminating your taxes. Okay, so we're kind of transitioning into our step-by-step. The first thing we need to do is understand the provisional income calculation. We need to be aware of this.
Mm-hmm.
The next step is what we're going to talk about here.
Okay, so how to win the tax game twice, right? So we've been kind of bagging on the tax deferred bucket there, but did you know that you can actually make the tax deferred bucket work to your favor dramatically? And we talk to a lot of clients that come our way, and they've already got money, allocated to 401ks and IRAs and things like that. And what we want to do is we want to do a very specific formula to understand how much they have versus how much they're going to get. Because if we do this, you can have your money both tax deferred and tax free.
Yep. So we can put the money into the account and get the deduction.
Yep.
And then we'll draw a little spigot here to take the money out. We can take it out tax free.
Okay. Now, if that doesn't sound like an awesome scenario,
awesome,
right? If you can get a deduction and have it come back tax free, that's a perfect scenario, right?
Win twice.
So let's talk about how much you should have or how much you can have in an IRA to be able to do that.
Yep. So step one is we need to estimate what your deductions are going to be. Okay.
In retirement.
In retirement. This is in retirement. So most people are not going to have a lot in the way of deductions. Most people, simply because they're in a situation where they're trying to conserve their income, their house is paid off or close to, kids are out of the house, they don't have as many working expenses, they don't have that second car, they don't have a lot of that kind of stuff going on. But then also things even like charitable deductions, it's not that you're less charitable, but if I have less income and more time, how am I going to choose to help? I'm probably going to give my time and not give as much money. So all those deductions we're used to taking are not going to be there. And most people end up in the standard deduction category, which means as a married couple, you get $12,200. Then your personal exemptions, you and your wife, $7,800. So that gives you about $20,000 in deductions. Now, just to make sure we understand what a deduction is, when you get $1 of income, you then have $1 of deduction against it. You get to report 0 taxable income.
So remember when we were looking at your taxes, Brad,
Yep.
That's how we got you to the 0% tax bracket is you had income, but you were able to offset that income with deductions.
With deductions, okay? So basically here what we're saying is the first $20,000 of income, you can offset that with these standard deductions. You don't have to pay anything. This isn't something you're buying. This is just free deductions of $20,000, okay? So step one is to understand provisional income and make sure that your Social Security is not taxable. That's step one. So whatever you collect in Social Security, not taxable, then we could add $20,000 to it, okay? So step two is calculating that Social Security factor. So the average couple today is collecting $26,500 in Social Security benefits combined, just a little bit more than $2,000 a month, okay? So toward their provisional income, 50% of that's going to be calculated. So $13,000 goes toward the provisional calculator, okay? So hopefully you can stay with us here. Now, step three is we combine this. The amount that goes toward our taxable, and if we've got an IRA, we can now distribute $18,000 to not end up paying anything in taxes.
At that tax.
And just in case this is confusing, this, if you add these together, we probably could have done this slide better. This is $32,000. So remember, we needed to be below 32,000. Oh, we did make the slides good. It's right there in front of my face. We need to be under $32,000 in provisional income. So we have $13,000 that is coming to you whether you want it or not, because you shouldn't not take your you should not claim your Social Security. It's money you already paid. You should take that, which means this is the big number that we're really trying to back into, is how much can we take from the tax deferred bucket and not pay taxes? That number, $18,000, give or take.
So here's the question then: how much can we have then in an IRA to be able to distribute $18,000?
Really, really good question. Okay. So most financial advisors we've gone through this before, but there's the 4% rule, right? So whatever you have in your account, if we start here, if you're planning on distributing money at the 4% rule, 18,000 divided by 4% gives you can have $468,200 in your retirement account and take it out at 4% per year and not pay any income taxes. Okay, but we shared some really cool stuff a couple webinars ago in the Maximizing Income section that told us that if we've got our finances structured properly, we should be able to distribute 7%, okay? And which means at that, you can only have $267,542.
Yeah. Now, here's one other thing. We talked a little bit about inflation. Your provisional income is not generally adjusted for inflation. In fact, it's very rarely adjusted for inflation.
It's currently not built. There's a lot of things that are automatically adjusted, like some exemptions, gift taxes and things are automatically adjusted. Provisional income is not adjusted. So it has to be brought up as a bill, passed through, and raised.
So these numbers, the reason I'm bringing that up, these numbers, this is just taking a pretty static distribution rate.
Yeah.
But the bottom line is you can have money in a tax deferred account and still get that money out at the best possible scenario. But what that means is if you're planning on taking a 7% distribution, the most you should have is 267. So if we sit down with you today and you have $100,000 in an IRA and you've got 10 years to retire, we can do some pretty rough estimate calculations to say, okay, you're going to be on track to have X at retirement. And what that means,
what if I'm on track to have more than 267?
Boom. That's exactly the scenario. Where should the rest of that money go? Number one, it should stop going to the tax deferred buckets.
Putting the money in. So if you're on track or already have more than that, stop putting money in the account, right? It's not helping your situation.
Yeah.
Okay.
But this is a pretty cool slide here because this does show you if you have money in a tax deferred bucket, you can win twice. And that, from a tax standpoint, there's nothing better.
It is. That's pretty amazing that we can put in the money and then take out $18,000 a year forever without ever paying income taxes. I mean, that's a pretty great deal. But unfortunately, it's oversold as more than that. That I don't argue with somebody if they're going to put that away.
Yeah.
Okay.
Okay, so let's talk a little bit about where should most of your money go. And you guys know what we talk about. Our bucket that we focus on is the tax-free bucket. So if we look at the tax-free buckets, most people don't know that there are very few options in the tax-free bucket. And I think most people would say they only know of two of those options. So option number one, if you want true tax-free growth, you could participate in in the Roth IRA. The Roth IRA allows you to take after-tax contributions and put it into an account that has special tax rules with it. And then once it's in the Roth IRA, you can invest in whatever you're going to invest in, whether it's mutual funds, stocks, in real estate in some cases, anything like that. Roth IRA is a government-controlled account, which means there are some provisions, there are some rules around that where they could potentially change those rules. Red tape, you've got some restricted access. You can't touch them. You can't take the money out before 59 and a half. I mean, there's all kinds of those same rules around a Roth IRA. But another account that you could potentially, we're just getting more and more on there. Why don't you go through those?
So we've got a lot of red tape. We've got contribution limits. This is probably the biggest one. If you're making more money than you can put into your qualified plan, you're probably not actually going to be able to contribute to a Roth IRA. That's kind of one of the big problems of it. Now, there are some backdoor ways to get around those, but those are pretty expensive when it comes to taxes because you've got to pay your highest marginal rates to do that. So it's actually a sneaky way of the IRS to get you to pay more in income taxes to be able to do that. We've got very restricted access. Even if we are financially successful and we make all this money and then want to retire at age 50, guess what? You're out of luck. You got to wait 9 more years. Okay, so we've got that, and it's generally pretty market focused. I mean, there's a bunch of reasons why Roths are not that ultimate solution. Okay.
Option number 2 could be municipal bonds, right? If you want to participate and lend money to your local or state government, there's some rules and regulations around that. You can have bonds attached to the municipality and receive tax-free growth. Now, there's some issues there as well. I mean, we can look at all kinds of different cities and municipal governments across the country to say, can they actually meet their obligations? They are an entity and an arm of the government that we just looked at. So there's problems there.
And right now, rates are in the toilet. They're terrible, right? It's really hard. So we're not getting much income from it. And then that's the thing, Ryan, is the risk. Now, the federal government can just print money to pay for their stuff. But can municipal governments do that? No. And municipal governments are over leveraged almost as badly as the federal government. So we actually have real default risk. And there's actually California starting to see this over and over. Google it. There's lots of towns that are cutting pensions, that are having to basically declare bankruptcy, and your muni bonds are on the list to be cut or defaulted on. I mean, at the end of the day, do you think they're going to send the little old lady out the door without money, or cut out the big bad investor who's trying to get tax-free income? Like, who's on the chopping block for that?
But this is the crazy thing. I mean, if you're looking at tax-free stuff, these are your only 2 options according to traditional media, right? This is what you're only going to be able to participate in. You guys know we focus on high cash value life insurance. In this example, we're going to call it a life insurance retirement plan, or a LIRP. And what that really means is you can put money into a life insurance policy structured the way we focus on structuring it, which is building and growing cash value. And one of the main reasons that we use life insurance is it's the third and last area that you can put money that will give you tax-free growth. Now, here's the cool thing. The first two examples, these are controlled by the government, right? These are Roth IRAs and municipal bonds. They're controlled, they're regulated by the government. The LIRP, the life insurance policy, it is a private contract that you own and you operate. And it is literally a contract. And so the insurance company that you're participating with, they have facilitated these type of contracts for hundreds of years. They give you guaranteed growth, they give you dividends. And you guys know we talk a lot about leverage and having the ability to use your capital in multiple locations, but man, it's a pretty awesome situation.
Yeah, and the point, we're not going to get into it here because it's a little bit too specific. We kind of debated back and forth, but the idea here is what you're going to find with the 3 buckets is you're going to want to only max out that contribution, like we said.
Kind of the Goldilocks. You want to have just not too much, not too little, but just the right amount.
So we're limited at 250K. We don't want much in the taxable bucket. We just want enough to be liquid here, which means when we fill that bucket up and we fill this bucket up, we need another bucket. So when a lot of people talk about how big should my policy be, it needs to be big enough to absorb
the
rest of what you're doing. And we're going to show you an example in a minute of how to really leverage that no matter how big that tax-free bucket is, to really leverage that to continue the tax-free idea. But that's the point here is the life insurance policy. We get so many people like, oh, I really like those benefits. What's the least amount I can put in there to get them? Like, no, let's go through this. Keep yourself liquid. If you've got a good plan and it makes sense to contribute, fine. And then basically everything else needs to go to the tax-free bucket. That's kind of the way we do the calculation on it.
Yeah.
Does that make sense? Okay. All right. So let's walk through this real quick here. We're going to just kind of summarize and bring it all together, and then we'll let you go. We've had you here for almost an hour. So we've got a tale of 2 income. We've got your average Joe sitting behind his computer working for retirement. I got the plan of hope here. And then we've got the investor. Okay. So the poor and the middle class, this is the way they structure their finances, as we've learned. They get a job that produces their income, and this is taxed as a paycheck.
So whatever your earned income rates are in the tax bracket that you're in, you're taxed at the highest possible bracket you can be in.
Yep. So ordinary income, we talked about that. If you're successful there, 55% of your income. Then with the money that they don't spend, they take that and put it where?
In a tax-deferred bucket.
In the tax-deferred bucket, okay? And that builds for however many years until they retire, and then they take their income and has their income come out.
Comes right back to them as ordinary income rate.
Just like a paycheck, okay?
And that's the scary thing. That's why we wanted to show you all of the precedents on the backside. Is that's why David Walker says it's a problem, man. You cannot keep putting your money there because that tax-deferred account there, whose money is that really? I mean, you know, we didn't share this analogy, but I like this analogy with IRAs. When you put your money into an IRA, it really is a partnership with the government. And the government comes to you and says, you do all the work, you put in all the money, you take all the risk, and we're not going to tell you how much of our partnership we actually own until you get ready to, take your money back.
Mm-hmm.
And at some future point when you get ready to retire, at that point we step in and tell you what tax rates are and how much of your capital that you did all the work for, you put all the money in, and you took all the risk for, how much you owe to us in taxes.
So one thing you need to do is go look up your retirement account and realize that the dollar value that it shows in there is not yours.
And that's a deceiving thing. You know, a lot of times I talk to people and they'll look at their account and they'll see $500,000 or $1 million. In fact, I was doing this with a family member not too long ago, and they have $1 million in a tax-deferred account, and that's what they think they have to spend. But as we went through this whole scenario here, and we calculated what taxes would be, they realized they only actually had $600,000 because the rest of that belongs to Uncle Sam.
And if tax rates double, how much do they have?
Not much.
Even less, right? But the thing that I want you to see with this visual is the poor and middle class. If you follow the goldfish advice, you cannot ever earn money like an investor. Even if you have cool investments in here, okay? I hear people all the time, I'm going to self-direct my 401k. That's fine. You can go change the type of investments. That's becoming more and more possible, but you don't get to earn your income the way an investor does, the way that the rich do, because when it comes out, it is taxed like the poor and the middle class. It is taxed as ordinary income.
And it makes you so vulnerable. So vulnerable.
You have no control, no protection. You will never be in a 0% tax bracket or a relatively low amount, okay? That's how the poor do it. How do the rich do it, okay? The rich focus, instead of making more money through their job, They want to make more money through either their business or
The assets that they own.
real estate or assets. Okay, that's why we said investment income is taxed differently. That's where they focus. Okay, they have to earn income along the way, and everybody pays a little bit in taxes, but their predominant focus is acquiring assets.
The right assets.
Okay, then what do?
Then they take that money and they put it in a tax-free bucket, right? Life insurance is a huge thing. I mean, if you Google and find out who actually owns life insurance, cash value life insurance, banks, corporations, highly compensated executives.
The wealthiest, the Rockefellers,
wealthiest,
the Rothschilds, those people that really understand what they're doing. So they fill up their tax-free bucket, and then where do you think they take the majority of their income from?
Tax-free.
Okay, so that they use that to they can use that bucket to generate income. Now, with the money that's not generating income for them, or before, when they're still working and before they have it, what can they do if they've got it in the right place?
Well, and this is what we spent so much of our previous webinars on, is how you can leverage the value of your policy to acquire more assets. We work with clients all the time that come to us and they have 10, 15 years to retirement and they don't have enough, right? And so we teach them how to make their money more productive, buying the right types of assets, focus on what we've got here, the four pillars of investments.
And if we focus on all four pillars, you can do what I do. I take my cash value and I buy real estate. And then all of those earnings with real estate, first off, I get to reduce my ordinary income, which is fantastic. And then all that money that I get, it's tax-free. And guess what I can do with it?
Do it again.
Well, I can put it right back in to buying more assets. And we have this cycle going. Now, when I go to retirement, I've got assets producing my income that fill my tax-free bucket that give me tax-free income. Pretty awesome scenario, okay? So this is what we want you to understand, that that's what we need to model. Not the traditional advice of max out your 401k so you can pay more in taxes.
Cool.
Easy.
Push
right?
that button, man. That was good. That was good. So here's kind of where we're going to leave you guys today. We've given you a lot of pretty specific advice, but it's not specific to you, right? So what we want to do is we want to call you to action. We're showing you taxes are going to go up. And if you're doing what most people are doing, you are literally holding a ticking time bomb in your hands, and all of your future retirement dreams, what you've been saving for all this time, are being put at risk. So what we really want to focus on is we want to focus on getting you a game plan that's specific to your financial plan, what you're trying to accomplish. So we've actually written a manual here. We've written an entire ebook on how to do this. You can read this book and you can take it to any CPA, any tax advisor in the entire world.
And
if you can get them to do this
for me.
Yeah, you can structure your finances exactly the way we talked
so you don't have to memorize the tax code. You don't have to find all this stuff. There are CPAs out there that if your CPA, if you don't feel like they're doing it, you can give this to them and they will do it. But man, I wish somebody already had done the work of finding a CPA that knew all this stuff, that could work with anyone all across the country digitally and educated them.
Wow, it sounds like you're building us up here.
Wouldn't that be awesome if we had a team member, somebody could share with me a team member that would do that?
Remember, what we're pitching here at Atlas is it's having the right education, the right team, and then the right opportunities. And the only reason that Brad and I have been able to do what we've been able to do is we acknowledge and give credit to the people around us. We have come in contact with the right team who's helped us organize and focus our investments in the right way. So
how much time do you spend with Jeff?
In the beginning I spent a lot, but now it's pretty turnkey.
Yeah, but I spent at least an hour a month.
Yeah,
at least talking to him. So it's key that you've got a good CPA that you can get that advice from. And guess what? We're going to show you how to do that in just a minute. But first, we don't have the link live quite yet, so we don't want to put it here because we don't want people jumping all over. But we're going to send a follow-up email early next week with the link to go get your copy of the ebook.
Yeah, and on this link, you're going to have some additional training where you're actually going to meet. You just mentioned Jeff. You're going to actually meet our CPA, and he's going to teach you some of the things that he's doing with us to help us structure our finances. And then we're going to actually give you an opportunity to work directly with Jeff. So we're helping getting this off the ground. But he runs a tax company called Elevation Tax. And as you mentioned, Brad, everything we do, we run by Jeff before we do it. Because the fastest way to make a dollar is to save it on taxes. And if we can structure our investments in a way to put us in the 0% tax bracket, that's what we focus on doing.
Yep.
So again, this email that we're going to send out to you is going to have some links so you can get some of these resources connected to Jeff, download the ebook, get some advanced training on all of this.
Yeah. Now,
really
for
forward.
you A students that are already Googling Elevation Tax, stop for just a minute, okay? The reason we don't have all of these links live and ready to go yet is we're trying to work out with Jeff some special offers that we can make you guys, because Jeff's good at what he does and he's worth every penny and he charges for it. Okay. But he knows that he likes to have educated clients that he enjoys working with. So we're almost done with figuring out a very, very special offer that we get to make to our clients to work with Jeff. So if you go now, they're not going to be able to set you up with it because it doesn't yet exist. So wait until we get that email before you reach out and contact Elevation Tax and Jeff Bullock so that you can get the awesome freebies and benefits and discounts that we're in the process of finalizing. But because you guys are kind of on the inside, you get to see behind the curtains as we're kind of putting this together. Before we roll this out to the broader public, obviously we'd have all this done. So we appreciate your patience there. But so there's going to be a couple things. We're going to send you a link with the download of the ebook. There's going to be a recording of this, as well as 2 additional videos that we recorded with Jeff explaining some more detail and covering some of the same stuff. And then third, there'll be an opportunity to go through and get signed up with Jeff, or at least explore what there is there and get some awesome freebies and discounts from doing that.
Awesome.
Does that sound
awesome.
okay?
That's been a fun hour. We've taken a good hour of your time tonight. And hopefully this was beneficial.
Who would have thought you'd been excited to sit through an hour-long conversation on taxes? Come on, pat yourself on the back.
Well,
You
underline
guys
that
survived.
0%. I mean, when we can talk to you about putting you in a lower tax bracket, that's really what this is all about. Because think about it, your retirement, your financial goals, your financial independence, it's not what you have made. It's not what you have in your savings account. It's what you get back in spendable income. And that's what this is always focused on.
Yep. So thanks again for joining us. Watch out for our email in the next couple of days. And then just keep watching out. We're going to do another webinar next month and keep bringing you awesome content. So thanks again for being part and joining us. And we'll catch you next time.